So part 1 was about the markets, and now we're going to look at the rate of returns, because nobody throws their money out there without the promise of rewards. Remember that? Risk versus rewards, the whole premise of, I think, Chapter 1, or actually of investing, is I have a risk, I need a reward. So let's look at this. The higher returns are associated with higher risks, principle 3, risk and reward. So let's kind of look at the figure they're talking about, because it sort of presents the question really well. Down here we have Treasury bills, and they're earning, it shows right here, at about 3%. Yeah, right at 3%. And then we go up, we have long-term government bonds. They're selling at maybe 5.5. This one's selling at 6. That's the corporate bond. Large stocks are returning 10%. I keep saying selling, I mean returning. And small stocks are actually returning right at 12%. And that was between the years 1926 to 2008. Now, an investment is an investment. Why such a large disparity here, from maybe 3% all the way up to 12%? What's the big playoff in here? Well, one of them is risk, right? Another one is inflation, where the inflation rate is running, and we're going to talk a little bit about that. Another portion is how long a time. Look at this. Especially here, long-term versus short-term. Look at the spread. So that causes a lot of angst, is how long do I have to wait for my money? Not only how long do I have to wait for my money, but the longer I wait for the money, the more risk there is. And that's kind of shown here. See the standard deviation of returns? The higher the deviation, the more erratic or up and down or risky the return is. And we're going to learn how to do standard deviations of the return in about 3 chapters. But right now, just know that the higher the standard of deviation is on the returns, the higher the risk, which is shown here. And the higher the risk, the more reward you want. So you've got several variables coming in here affecting the rate of return from the money market and from the financial market. So let's look at some terms. We're looking at opportunity cost, and that's literally is, what can I do with this money other than investment? It's a lost opportunity. I could either save my money, or I could, well, I guess I could reverse that, would be more sense. I can buy a car, or I can save that money and put it in a treasury bill. So I'm trading off. There's pleasure in having the car. The car may get me to work. The car may give me added opportunity to make more money than just putting it into a treasury bill. So the opportunity cost. What if I tie my money up for 10 years? What could I be doing with that money in between that 10 years? Okay, if I'm going to tie my money up, I want to be rewarded for that. So opportunity cost plays a big portion here. I just talked about the standard deviation, and that's a variability around the mean of the rate of return. And what that says is all of these returns, here's my average, how far does that deviate from there? And the wider the deviation and the more dispersed it is, the more risk there is. There's the real return, and that would be the return that you earn above the rate of inflation. There's a maturity premium, and that talks about, how do I want to put that? Discussing that long period of time. If I'm going to wait 15 years for that to mature, I want a reward for that, on top of the regular return. Then there's liquidity, and the liquidity premium is not only do I wait a long period of time, I'm losing opportunity. I can't cash that in immediately, possibly. There may be restrictions on that. Okay, so if there's a liquidity a restriction on that, I want to be rewarded for that also. So you're looking at investors that I can't convert it immediately to money, so you need to pay me more to leave it in there, type thing. So now let's look at the interest rates. There's a direct relationship between inflation and interest rates, obviously. There's also a relationship between the default possibility on that 30-year note or bond, the maturity premium of tying my money up for that great amount of time, I'm waiting all that time, and also a liquidity premium that I can't cash it in right away. It's not liquid. So if you look at these rates, this is the inflation rate, okay? And the rates here pretty well follow the inflation rate. The inflation rate goes up, the interest rate should go up. But right in here, 2002 to 2006, things kind of got a little bit switched around. This was right after the collapse in 2002 and the bubble for technology burst here, and right before 2008. There's something very odd going on when interest rates dip below the inflation rate, as you can see. So, but for the most part, inflation is matched by the interest rate, right? And this is your 3-month. Here is your 30-year. Now, the 30-year is higher, and what is that taking into consideration? Well, it's taking the maturity, the default rate, it's taking in the length of time. So all of those are going higher, but look what's happening here. For that 30-year, it's compared to the Treasury bond. The Treasury bonds actually met and matched in 2000. This entire period from, whoops, I just moved that, from 2000 to 2008 was very unpredictable, as you can see, just looking at interest rates, what's going on. And then the AAA corporate bonds obviously have the highest return, and they've pretty well matched the 30-year Treasury bonds with just a slight increase in rate due to the default rate and the fact that it's not guaranteed by the government in that manner. But look at where our interest rates have come. We started in 1984, clear up here. And now as you get down to 2008, interest rates are much lower. And obviously, inflation rate is almost negative at this point here. So you can see how that does affect the interest rates. So a visual on all of this. So it gives you something to wrap this around. So what determines this? Now this is kind of confusing. So just hang in there. This is terms, okay? The nominal interest rate, which is the interest rate that's stated right there in front of you, it involves the real risk-free rate, which is your Treasury bond, your Treasury bill, plus the inflation rate risk premium, whatever the inflation rate is, plus the default risk premium, plus the maturity premium, plus the liquidity premium. So that's the nominal. Okay, and this is the quoted rate for securities, okay? The interest rate. So, and this is very important when companies go to set their interest rate. What are all of these variables that I have to consider when I look at my discount rate or the interest rate I want to pay or that I want to receive from my bond? So, the nominal interest rate equals the real rate of interest plus the inflation rate. And the real rate, which is this right here, includes the default, the maturity, and the liquidity premiums. So all of these mixed together will give you the interest rate. The other thing we look at is it's called the term structure of interest rates to yield or yield to maturity. So let's just look at this graph, okay? I think it really speaks. So here's 1 year, let's say a short-term interest rate at maybe 5%. But as you go to a longer period to maturity, that rate goes up, up, up. And that's the general trend. So there's some theories about this, and that comes down to the unbiased expectation theory. There's 3 of them. And investors expect future, expectations of future interest rates. Do I expect it to be higher? It's going to be in there. Liquidity, again, you're looking at that maturity premium we talked about. And the market segment. There are some legal restrictions on some of the what some institutes can invest in, and what some pension plans, or even what some individual investors could invest in. And then there's personal preferences that get into that theory. So that kind of restricts the structure. And there'll be more on this one later. And finally, we look at the finance and multinational firms. Obviously, this is kind of a no-brainer, but I wanted to go through it anyway. A well-developed financial market, such as the U.S., contributes to the overall growth of the economy. So when your market is stable, when your market is true, when your market is not corrupt, it's going to promote the growth of your economy. Without those 3 things, stability, honesty, being able to transparency, without those 3 things, your market is not going to grow, neither will your economy. People can't deal in a market that is so unstable and uncertain. Your government also has to be stable to solidify those financial markets. We have a very well-defined, developed financial market, and it does allow for very efficient transfer of capital from the savers to the users, people with surplus to people with a deficit. So this leads to some very good financial investing. Savers get more, and the people with a deficit, or the institutions with a deficit, get to grow more value for their companies. Multinational companies with excess cash prefer to invest in companies such as the U.S. And in number 1, that's because we have a developed financial market and we have a stable political environment. We don't have to worry about governmental confiscation of private enterprise. Whereas developing companies who actually need the money or the investment don't attract as many investment firms, because their economy is not as stable, their financial markets aren't stable, and their government isn't stable. So looking across the board, that's why we have so much investment coming into the U.S. We have our financial markets stable, we have our capital markets stable, our money markets are stable, and our government is stable, which makes our economy stable and growing. So that's just sort of a very, very quick and dirty about the rates on return in the financial markets. Those factors are what makes our economy work and our markets work. So I will see you in the next video, and we will talk about what we need to do for the assignments for this week. Thank you.